Hey everyone, welcome to another episode of Mayhem in the Markets, brought to you by TraderAid.com. It's Monday, December 26th. I hope everyone's had a great holiday break and are preparing for a festive year ahead. We can see that since the start of the pandemic, the mortgage payment on a median priced house in America with a 10% down payment has doubled. And that's not a good sign. Going into the pandemic, about 50% of millennials were living at home with their parents. So this just makes the idea, the American dream of owning one's own home, even less attainable for a very important component of our population. Because who are going to replace those that are downsizing because of retirement, financial needs, simplifying their lives, reducing the number of stairs in their house as their joints aren't working as well, or unfortunately even dying? That demand, as people age, is going to drop from that generation. And yet the younger generations aren't given an opportunity to really come in and buy that housing stock. And housing stock in the US has also been growing over the last several years. And we've been given a narrative that supply was very tight, but this was as investors were buying up second, third, fourth homes, and then institutions were buying up dozens, if not hundreds of homes and selling them in private and public REITs and also buying multifamily units. The reality is we're not underhoused in America. There's actually a lot of supply that could come online, and maybe that's the best thing for the younger generations, for home prices to fall 20, 30 or more percent as a part of a crisis that compels the Fed to consider cutting rates. So maybe in the future, maybe in a year or two, they'll have a chance at buying a home. But right now, they're effectively locked out. And that is going to be a problem in a country where 67% of demand is driven by consumers. That's 67% of GDP. It's not going to be replaced as easily, because think about it. When you buy a home, or when you buy a larger home, you're filling it with new things. You're getting work done on it. You have to maintain it. You replace those things that you've bought. You add new things to the existing things that you have. And I'm just trying to keep this broad, but think about it. You get a refrigerator, you get an oven, you get a flat screen TV, you get a couch, you get a rug, you get a bed. Like, all of these are part of the consumption that drives the global economy. And this isn't going to be replaced by folks that have to continue to live either with their folks or live very small, because unfortunately, by necessity, a lot of people are also buying smaller and smaller homes or renting smaller and smaller homes. And it's because of financial necessity. It's also to some degree because of practicality. When you look at certain places, how expensive the cost of living is. I just saw an article about someone who had a apartment in New York, and it was like 103 square feet or something obscenely tiny. And it looked like an impossible place to live. And no disrespect to anyone doing that. That's not my intent. It just illustrates to me just how out of control the cost of living has become. And we're just looking at this through the lens of buying a home. But renting has become extremely expensive. Health insurance, utilities, property taxes if one owns a home, and if one rents, they still pay it in other ways as the rent goes up. Everything has been increasing. Of course, food, energy has been on the downtrend for a bit, and that's great and that's helpful. But the average cost of living for Americans has risen so much over the last year and a half, that many are struggling, going into greater amounts of credit card debt. We're starting to see delinquencies rise. And unfortunately, that same generation that I named, millennials, this is a pretty big, important part of their borrowing right now is credit card borrowing. And we're seeing more and more of these loans in distress. By some measures, up to 18% or so. So this doesn't paint a very good picture for the generation that needs to come online and kind of replace older generations of consumers. It seems they're already constrained, and yet they haven't sort of consumed commensurate as to where prior generations were around their age. And so it suggests a lot of demand being knocked offline for an economy that relies on demand for 2/3 of its growth. That concerns me. It really does. And I feel bad because it's almost like a lost generation at this point. And if you're out there and you're listening and you're a millennial, my heartfelt, I just feel bad. I really do. Because There's a lot of factors that have undermined this generation's ability to succeed in this country. Whether it was the disproportionate response to the great financial crisis by helping the companies rather than the people, and also engendering one of the biggest multi-asset bubbles in history that unfortunately locked a lot of millennials out of being able to buy a home as a part of all of that cheap liquidity flooding the global financial system. If you're out there and you're listening and you're in that demographic and you've done well for yourself, congratulations, you're among the select few. Statistical improbability. Help others in your generation do better too. See what you can do if there's anything you can do to help others, because this is a real struggle for a lot of people. The next chart we have here, which doubles down on the same thing we've been talking about here, just the cost of living being stubbornly high as well as inflation. It all feeds into the same equation here. People are paying more to get the same or less. So we had some good news and some bad news in the PCE services reading from Friday. The good news was that goods prices dropped 0.4%. The bad news is that the price for services increased 0.4%. These are all both month-over-month measures. Food prices also increased 0.3%. Now, what does this tell us? Well, we know that people are leaning back on buying goods after an unprecedented amount of demand during and just after the COVID crisis for goods. They're starting to scale back, but services prices are increasing, and so is the demand for some of these services. And one of the things that's concerning here is this is a stickier component of inflation, and it can drive wages higher, which can drive services higher, and it can create some degree of a wage price spiral, which was a concern that both Powell and Lagarde spoke to during their last respective central bank press conferences. And the concern is essentially that if this becomes entrenched, then it starts to create wage inflation that outpaces what these central banks are comfortable with, because that then feeds back into the same services inflation, and you get that spiral. Now, is that likely to happen in the here and now? We don't know yet. We just don't know. We haven't had enough time to see how this all plays out. We know that central bank policy is succeeding in reducing demand for goods. We know that central bank policy is deflating some of the asset bubbles that we've seen out there, and with it, some of the wealth effects that have reduced the participation in the labor force. But we also know that central bank policy has not gone far enough, unfortunately, to see the stickier inflation slow. We need to see disinflation. It's unlikely we'll see real deflation in the next several months, but we could if we start to see a financial dislocation gain momentum. But we do need to see disinflation, and that's what central banks are hoping for, ultimately to reach an inflation rate year over year of about 2%. We're far from it now. The PCE reading came in at 4.7% year over year. The Fed, again, wants to see 2%. So they have work to do. Their models show that they might reach that within the next several years. Basically, end of 2024 is what they're thinking with their SEP that was released in December. Now, that leads us to a path where looking at data is incredibly important. Because if we're not focused on the data, we're not going to see when these stickier components of inflation are meaningfully reducing, such that central banks become more satisfied with the trajectory of inflation. If we're just looking at the headline data, it looks like everything's coming down and we're going back to a more normalized environment. But there are two big items to consider here. First, the price of what we're buying is not decreasing. What's decreasing is the rate at which it is becoming more expensive. That rate of measurement is how we look at these CPI, PCE, PPI indices. So we're still in an environment where it's unaffordable for a lot of people. We just talked about that with the millennial generation, Gen Z, impacted by similar. This is something that's going to knock a lot of consumers offline unless and until prices really actually fall. They need to fall quite a bit. Maybe we'll see that, at least on a short-term basis, before demand starts to rise again. But we need to start seeing inflation's velocity slow. That's disinflation. That's what the Fed's looking for. They're okay with some level of inflation. They don't want it this high. It really is a concern. And look, they're acting with reason. I know there's been a lot of people out there who have been saying the Fed's gone too far. They've hiked more than they need to. There's all these lag impacts of their policy in the real economy. I don't think that's true. I do agree that there's lag impacts, but I don't think it's true that they've gone too far. Why? Because first, this is the most transparent Fed there's ever been. They've told the entire world exactly what to expect from them, and they've adjusted as the data has disappointed them to become more hawkish. And they've said they would do that. They said they're very data-driven, particularly concerned about inflation, almost becoming a one policy central bank with the economy, with employment really on the back burner right now, even directly saying the jobs market needs to cool. So not only are they not looking for maximum employment right now, they actually want to see, or are at least accepting of, a higher level of unemployment. So inflation is going to be a major metric. It's why the market has reacted to CPI releases with such volatility, because it's the most important economic data this year, at least based on what the market is pricing and, of course, what our central bank is talking about. Obviously, it's very important how the labor market does in real life. Wages have not kept pace for the average worker versus a CEO or versus the corporate profits that have been taken for several decades. In fact, wages in real terms, when you measure wages against inflation, have been falling. That's a big problem. Think about that. Now you have your wage and it's going up and you're happy, but then you look at your bills and your wage is still not keeping pace. Now it's becoming harder to stay afloat, which is one reason why we have so many people that are borrowing so much on their credit cards. And that's why we're seeing higher delinquencies and higher debt burdens for the average American. Now, I know when we zoom out and we look at the entire data set, we can see that it looks like the consumer's in better shape. Their debt service costs are low. They have a lot of cash. But look at lower income components of our population. Look at the bottom 60% of earners, and the picture is completely different. Look at younger generations. The picture is completely different. Look at different demographics in this country. In the South, the situation's not so good either. I think that we have to slice up this data and really look at it by sheer volume too. Because if we're just looking at averages and we let the 1% or 0.1% of the richest in this country skew them, then we're not getting very good data. So I don't think the consumer's in good shape. I think that this is a precarious situation for people who are already overextended to be heading into a difficult economic environment where they may lose their job or they may have to take a pay cut. Or if they're working on a gig, like driving an Uber or doing delivery, they may see that work dry up. This is probably going to be a tough time. So I think that looking at this data, we're going to want to see what happens with inflation in the next quarter. The first 3 months of 2023 will be pretty telling for how the year may go. And I think we'll start to see more deceleration. I think we'll begin to see some signs of improvement. I don't know if it will be enough for the Fed to say they're satisfied anytime soon, but I think we'll continue to see improvement, but stickiness as well. Some of these components are likely to be sticky. Healthcare costs very rarely fall. Education costs very rarely fall. Rents have a lagged impact, so do home prices and the total cost of home ownership. Utilities too. There's a lot of lag time in this stuff that's going to make it a little stickier, and some of these prices may not fall at all. They may just slow in the rate they're appreciating, which again is enough to satisfy the Fed, but it's not enough for a lot of people out there that are already struggling. Bank losses are widening. This is something that I think is going to be important to keep an eye on because it may be one of the reasons that we're seeing increased borrowing at the Fed's discount window. Those charts have gone viral on Twitter, TikTok, YouTube. A lot of people assuming that it's the end of the world, that the discount window is being modestly tapped into. I don't see it that way. I see it as just the Fed's tightened as fast as they ever have in history. The whole financial system hasn't broken, at least yet. And there's some modest borrowing at the discount window as bank losses are widening. It could be from small and medium-sized or regional banks that are dealing with their own specific problems. It could also be dealing, or as a result of some of these unrealized losses, the banks may not want to realize them if they think these assets are going to come back. And so they may borrow using these assets as collateral at the discount window so they can be liquid, which is fine. There's nothing wrong with that as long as it doesn't turn into a crisis situation. And that looks like the discount window borrowing going parabolic, which it has not. It's been orderly. So these losses are something to keep an eye on. Obviously, we are concerned about next year because these losses could continue to widen. We're going to hear a little bit more about what banks are looking at as earnings start in mid-January. JP Morgan's on January 13th should help to shed some light as to what banks are looking for and what they've been experiencing. And that'll give us a better idea of what's going on in the economy because they're kind of connected to all of it. And that gets us to a less pleasant question. Are banks really well capitalized? We just need to know more because we don't want to repeat of any kind of financial crisis like the Great Financial Crisis. And yet, this article in the Financial Times suggests that the country's 8 biggest banks, that being the U.S., have a buffer against unexpected losses only about the same size that they had in 2006 as we approach the financial crisis and the recession that followed. Now, that doesn't mean that we are inevitably headed towards some sorts of financial dislocation, but what it does suggest is that we're more vulnerable than what we've heard. The narrative has been banks have never been better capitalized, but maybe they're not. Maybe they're not as well capitalized as we've been told. The Financial Times is a very good financial publication in the sense they don't typically publish, clickbaity articles or look to try to inflame this stuff. So I'd be less concerned about them running a story like this saying, looks like there's actually some serious risk here, than I would if it was in like the New York Post or something like that, where they're a little bit more sensationalistic. And I'm not trying to criticize any publication specifically here. I'm just saying that consider the source. These 8 institutions called global systematically important banks, because of their size and complexity, have an outsized impact on the domestic and global economies, now have tangible capital covering only 6.7% of their 14.7 trillion in total assets, according to the most recent Fed data. This crucial measure of financial resilience, called Tier 1 leverage ratio, is only 0.7 percentage points higher than that recorded in 2006. In other words, the U.S.'s largest, most systematically important banks are almost as highly leveraged today as they were just before the Great Financial Crisis. Should the economy experience a significant slowdown, it is likely that this level of leverage would negatively affect financial firms and intensify any recession within the U.S. and global economies. Banks should cautiously repair their capital buffers now before a possible recession undermines the public's trust in them. So, this is not what we would want to see ahead of a recession, this level of vulnerability, of fragility. And I think it's something that we need to keep in the back of our minds, especially as we go through earnings season and see how some of these banks are really doing, and we prepare for the year ahead. I also wanted to give everyone a special heads up. At TraderAid.com, we are giving you a 30% discount. That's the best sale we've ever done. Use the code HOLIDAY2022. It's good until January 2nd, 2023. You can get 30% off our monthly or yearly plans of TraderAid or TraderAid Plus, as well as video courses on the website. That code again is HOLIDAY2022. Just visit TraderAid.com to learn more. The Bank of Japan has widened its band around its yield cap. Now, this led to an immediate surge in rates to about 0.41%. The Bank of Japan has repeatedly suggested that they're not tightening, but this smells a whole lot like tightening to me. I know they're also trying to become more, let's call it, understanding that they are in a new regime for bond market volatility. That's something that causes the Bank of Japan to probably have to be a little bit more considerate that the environment now is nothing like the environment of the past, because all the central bank liquidity has been and continues to be drawn out of the system month by month with quantitative tightening. We're seeing balance sheets shrink. And I know that there's been some discourse about this one way or the other. Some say this is a really big deal and we should be concerned about it. I fall into that camp. Others have said, this is such a small amount of overall tightening that it really shouldn't matter. And that some studies have even suggested that the interest rate increase by $2 trillion of runoff is something like 0.5% or 0.25%. I couldn't disagree more. I think that quantitative tightening is a really big deal. It exacerbated the bear market in 2008 when the Fed did it by another name. They were running off their balance sheets. You can look at the charts and see that during that time period, the Fed was shrinking their balance sheet, and it seems to have, at least from circumstantial evidence, increased illiquidity, volatility, and contagion effects during that time. 2018, they were rolling off their balance sheet for over a year at that point when we saw the 2018 tightening tantrum in December. And what really salved the nerves of the markets was when they stopped tightening, when they stopped rolling off assets from their balance sheet. And then eventually, they did go back to quantitative easing. Enter COVID, the biggest QE we've ever seen in terms of the velocity of money entering the financial system from globally coordinated monetary policy loosening. And now, central banks around the world are engaging in the most aggressive tightening. Some historically, some ever, that we've seen. That is to say that at this point, because we're seeing not only rate hikes from the lowest base with the greatest rate of change from that base, but also central banks rolling off assets from their balance sheets at the same time. This is the most aggressive tightening cycle ever, if you consider both of those factors, for all the central banks in question. Why does that matter? Because this entire 14-year on and off easing cycle that fomented one of the biggest multi-asset bubbles in human history, if not the biggest, was in no small part driven by QE and rates being artificially cheap. That stimulus is gone. And we're seeing it withdrawn ever more as months, as days even go by. So the Bank of Japan has to deal with a world of lower liquidity, and lower liquidity means higher volatility, particularly in bond and currency markets, but perhaps eventually even in equity markets. That is to say, the volatility in bond markets and currency markets has been a lot more violent compared to their normal levels of volatility than what we've seen in equity markets in comparison, which by their nature are more volatile. And yet the volatility in this bear market has been overall relatively tame compared to what we've seen in some prior bear markets. Maybe we head in a direction where we start to realize those higher levels of volatility in the equity market as well, with liquidity continuing to leave the global financial system. But one thing is certain. When the Bank of Japan says they're going to widen the band around its yield cap, that's telling us that they are not certain that they can contain it with the prior cap. So instead of it being plus 25 to minus 25 basis points, it's going to be plus 50 to minus 50 basis points. And they also increased the cash that they would be using for their bond yield curve control program to $9 billion, which is $9 billion US, which is kind of a big deal, but it just shows us that they're willing to try to defend a bond market that will eventually become indefensible, and are probably heading in a direction of further tightening out of necessity, because eventually the yield band on the 10-year Japanese government bond will probably need to be closer to plus 1 to minus 1%. It wouldn't be too extraordinary to think that that could happen. as we navigate through 2023. Kuroda is going to be replaced in April. He may be setting the stage for his successor to begin at least modestly tightening monetary policy. Remember, this is a country that has over 200% debt to GDP. They do have a high savings rate, but that's in the retirement age folks. Younger folks are not doing quite as well in Japan. These demographic problems that we're facing in America are not unique to this country. There are demographic challenges all over the world now. So I think that we're going to have to see the Bank of Japan adjust to a new reality of a much less liquid world. And that probably means greater volatility in their bond and currency and equity markets throughout 2023, unless something changes, unless something big enough breaks and central banks then have the cover to go back to this sort of monetization of government debt and the financial system at large. Another interesting bit came out from the Federal Reserve Bank of Philadelphia talking about whether the job recovery is what it seems or not. And I don't want to politicize this because, let's be real, BLS data, other kinds of employment data is problematic no matter who's in power. The data sets tend to be not as reliable, particularly in an economy that's driven by so many gig jobs. But nevertheless, the data sets that we were given suggested that over 1 million jobs were created between March and June of 2022, and yet the Philadelphia Fed is saying maybe it's closer to 10,500. Now, that's a big disparity. We don't know if this is an accurate assessment, but if it is, then that's a pretty big problem. And it may give us some other ideas as to why the labor force participation rate has remained so stubbornly low, but why unemployment isn't that high, because unemployment data only measures people that are receiving unemployment benefits. That data is not a good benchmark to look at for the health of the job market. And I know the Fed cites it, and I know other economists cite it, but if you're drawing on unemployment, there's a limited timetable. If you're much longer term unemployed, you're not necessarily counted in this data if you're not receiving those benefits. And that, to me, tells us that we can't rely on this data set to say this is how well the labor market is doing. It may be good cover for the Fed to tighten when the unemployment rate is low, but if we have a structurally broken labor market where the labor force participation rate continues to tumble one crisis to the next, and when we have so many American households living paycheck to paycheck and going eyeball deep in credit card debt just to survive, that doesn't suggest that we have a very healthy economy. And unfortunately, with the labor force participation rate as low as it is, we've got a combination of different factors that could be feeding into that, but none of it tells us we're in a great place. We have artificial wealth effects that allowed people to retire early, giving the Fed cover to continue to lean into tightening. But we also have a lot of folks that weren't able to find jobs after COVID or even after the great financial crisis and participate in the economy as they wanted to. So they may have had to retire earlier, downsize significantly, live on what they could, take on part-time work, take on contract work, participate in the so-called gig economy. But if we aren't seeing the kind of job recovery we thought after one of the worst firing crises, job destruction crises we've ever seen in such a short period of time, that concerns me in terms of how strong, how resilient households will be going into what is likely to be a recession next year. Finally, we have Apple is bigger than the top Chinese companies, the top 10, all combined in market capitalization. So the query here is this a sign of a bubble? Is this a sign of Chinese tech being cheap, or both, or maybe even neither? It's an interesting chart just to see how big Apple is. The biggest company in the world, and really, quite frankly, one of the most interesting companies in the world, how they've grown, how they've been able to take this revolutionary technology that they made that became the standard for mobile phones in much of the world, but then also how they've been able to build this services economy on top of all of it. The App Store, Apple TV, Apple Music, all the other products that they've added in. It's a very interesting sort of ecosystem altogether, the hardware and the software and Apple being able to become sort of top tier. And they've done it because it's easy. They've done it because their products are work well and last a long time. And you can make your laptop and your tablet and your phone all work together almost effortlessly. So I can see exactly why they've become as large as they have, and it certainly makes sense. But it's also just incredible to see a company become that large and that important to the global economy. And Apple's moving out of China. They're slowly getting away from doing a lot of business in that country, which honestly, it makes a lot of sense. There are not only areas of opportunity where there are less oppressive governments to do business and lower cost of manufacturing, but you also don't want to have all your eggs in one basket as a company. It's just problematic to do that. It makes you very vulnerable. And China could, at this point, with the way Apple is still very reliant on them, they could really hurt Apple, inadvertently even. This COVID reopening could cause some disruptions for Apple's production because there are waves of infection that could take people out of the workforce. We'll just have to see what happens. But I think that it's smart for Apple's management to say, you know what? Let's diversify. Let's do some reshoring in the US. Let's do some nearshoring to some of these other countries. Let's do some diversification of our basket of countries in Asia that are manufacturing for us and really diversify away from China so that they are able to withstand disruption in the Chinese economy and otherwise. I think it makes a lot of sense. I think it's smart. And honestly, I've been very impressed by Apple's management for a long time, and I didn't want to be, because there are things the company does that I'm not a big fan of, like lock people into their hardware. You buy a Mac, you can't replace the battery, you can't replace the storage, you can't replace the memory, and if something breaks, you pretty much have to buy a whole new one if Apple Care doesn't cover it, or if it's outside of the warranty. So it's already an expensive computer that you can't fix or upgrade. I'm not a huge fan of that, but I understand what they're doing. They're locking people in, they're increasing the replacement cycle in terms of how many laptops people are likely to buy over a set time period. And it's smart business. It's not what I'd like to see, but I understand why they work, and there's a number of other things they do that I admire. So this explains why they could be so big. It also gets us to the question of, are Chinese companies starting to become cheap here? And I think a lot of that has to do with what happens next. Does the government stimulate the economy, or do they kind of do this lackluster piecemeal, kind of keeping everything held back approach that they've done so far? We'll have to see what 2023 brings. I think that the Chinese government is a little bit concerned that if they go full into stimulus, it will unleash a wave of global inflation that will cause other central banks to have to tighten, and it'll be a net impact of much less desirable outcomes than anyone wants. So there might be some restraint there because they want to see these inflationary pressures come under control, because otherwise they could come home to roost. And China's a country that doesn't do well with high inflation or high unemployment. And if they have both, it can be the seeds for more significant unrest, sort of like what we saw in those multi-city protests that eventually led to an easing of policy. So that's all I've got for everyone. Really appreciate you tuning in. Please do check out TraderAid.com if you're interested in more content like this. You can always sign up for a 30% discount by using the code HOLIDAY2022. I'll catch you all next time. Hey everyone, welcome to another episode of Mayhem in the Markets, brought to you by TraderAid.com. It's Monday, December